Hello financial fans, welcome back to another stock analysis. Today we'll be covering United Parcel Services stock ticker UPS. UPS is a global logistics and delivery company that provides transportation, logistics and supply chain management services. It operates in over 220 countries and territories and is known for its signature brown delivery trucks and uniformed drivers. The company is currently sitting at a market cap of $165.5 billion, and in 2022 they generated a revenue of $100 billion. The dividend yield is currently sitting at a very solid 3.41%. 63% of their revenue comes from US domestic package, 20% from international package, and 17% from supply chain and freight. To determine the final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25%. That can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety can increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. First two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $7 billion in 2013 to almost $14 billion in 2022. The average EBIT growth is 9.4%, which is no change in the margin of safety. The margin has also gone up over the years, going from 12.76% in 2013 to 13.74%. The average margin growth is 2.2%, which is a 5% deduction in the margin of safety. The next two ratios are the dividend growth and payout ratio. Dividends have gone up over the years, going from $2.48 a share in 2013 to $6.48 a share in 2023. Dividend growth is a very nice 10.7%, which is a 5% deduction in the margin of safety. This with a payout ratio sitting at 46%, which is no change in margin of safety. And the final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get the debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. For UPS, this is under half a year, in this case only a 36% debt to EBITDA ratio, which is a 5% deduction in the margin of safety. The return on invested capital for UPS is sitting at 20%, indicating that the management is very effective at allocating capital, which is a 5% deduction in the margin of safety once again. Looking very good so far for UPS. Let's go look at the valuation models next to determine the intrinsic value of UPS. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of UPS going from 2018 to 2022. The average growth rate in the free cash flow during this period was 41.13%, and I'm projecting expected growth rate in the future free cash flow of 2% over the next 10 years, mainly because I think the shipping bubble, or the vast majority of the shipping bubble, is already over, so I'm only expecting a 2% increase. With this percentage, we'll determine the future free cash flow for UPS and determine a terminal year valuation, using a perpetual growth rate of 3% and a discount rate of 8.5%. Which gives us a sum of free cash flow of $155 billion. And to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $149 billion. And all we have to do to get an intrinsic value out of this model then is to divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of $206.01, which is a 6.89% upside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of UPS going from 4 years ago to the current year. The average growth rate in their dividends during this period was 15.45%. And I'm projecting expected growth rate in all of their future dividends of 5.5%. And we'll once again be using a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $227.88, which is an 18.24% upside out of this model. The next model that we'll be using is Grain's devised valuation formula. In this model, we take a look at the earnings per share that UPS is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory that a company with no growth is always sitting at a PE of 7. Looking at all of these metrics, we get a fair value of this model of $145.20, which is a 24.66% downside out of this model. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to UPS, take a look at their stock price and their earnings per share. And this way we can determine the average PE multiple in the industry, which in this case is sitting at 19.55. Now all we have to do to get our intrinsic value out of the model is to multiply by the earnings per share that UPS is generating, which is $13.20 a share, giving us a fair value of $258, which is a 33.87% upside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of the past 5 years, and on average it has been sitting at 3%, while the current yield is sitting at 3.44%, indicating that it's currently undervalued on this metric. Doing the same with the PE ratio, the average PE ratio of the past 5 years has been sitting at 19.17. While the current PE ratio is only sitting at 14.60, indicating that it's once again undervalued on this metric as well, giving us a fair value of this model of $236.88, which is a 22.91% upside out of this model. If you want to get access to all of my models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting this self-promotion out of the way, let's go look at the final overview of valuation next. Coming to our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $214.79. A margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting by 5% for the debt to EBITDA, 5% for the margin growth, 5% for return on invested capital, and 10% for the dividend growth, leaving us with no margin of safety at all. This means the fair value is the same as the average out of all of our models. And with the current price of $192.72, we get an upside of 11.45%, indicating that it's currently a moderate buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.